Hello everyone. So under this video, we are going to compute the income from house property for the assessment year 2020-21 of Mr. X, who has two houses at Chennai. So the information has been given regarding house 1 and house 2. So they have given you the fair rental value, which is per annum, the actual rent, which is per month, the municipal rental value, which is per annum, then the standard rent, which is per annum. But house number 2, the information is not available. Then the municipal tax, then the actual repair expenses, the ground rent, the collection charges, then the interest on loan, that is 12,000 for the first house, 48,000 for the second house. Vacancy period 3 months for the first house, there's no vacancy for the house number 2. Then the unrealized rent for the first house, there's no unrealized rent, but for the second house there is for 36,000. Then it says that the construction of house number 2 started on 1st November 2015 and he borrowed rupees 4 lakhs at the rate of 12% on 1st July 2016 for the completion of the house. The house was completed on 30th November 2018 and since then it was let out. So let us look at how to calculate the pre-construction interest first of all. So to calculate the pre-construction interest, you have to note down two things: the date of borrowing and the date of completion. So the date of borrowing here is 1st July 2016 and the date of completion is 30th November 2018. Then after that you have to define the pre-construction period. So the pre-construction period under this problem will be from 1st July 2016 then to 31st March 2018. So this 31st March 2018 is a financial year immediately preceding to the year of completion. So in this case, the date of completion is 30th November 2018 and the financial year prior to this date ends on 31st March 2018. So the pre-construction period will be 21 months in total. That is from 1st July 2016 to 31st March 2017 will be 9 months. And from 1st April 2017 to 31st March 2018 will be 12 months. So the interest for the pre-construction period will be in total 84,000. So this 84,000 will be allowed as deduction under section 24B for 5 previous year. So under this case, for this current previous year will be 16,800. Then the current previous year interest is given in the problem itself, that is 48,000. So the total interest of previous year 2019-20 or for the assessment year 2020-21 will be 64,800. That is 16,800 plus the current previous year interest 48,000. Now let us look at a solution. So first of all, we have to find out the gross annual value. So to find out the gross annual value, there are 5 steps. So step number 1, we have to see the reasonable expected rent, or you have to find out the reasonable expected rent. That is, you have to compare between the municipal valuation or the fair rent, whichever is higher, but subject to the maximum of SR. So now if you look at the problem, the fair rental value of house number 1 is 1,36,000. Then the municipal rental value is 40,000 and the standard rent is 38,000. So the higher between the fair rent and the municipal rental value, so the fair rent is higher, that is 1,36,000, but the standard rent is 38,000. So you can't go beyond the standard rent. So for house number 1, the reasonable expected rent will be 38,000. Then for house number 2, the fair rent is 1,20,000, but the municipal rental value is 1,30,000. So there's no standard rent. So the higher between these two is the municipal value, that is 1,30,000. Then step number 2, you have to calculate the rent received / receivable after deducting unrealized rent, but before adjusting loss due to vacancy. So for the first house, the monthly rent or the actual rent per month is 4,000. So into 12 will be 48,000. Then for house number 2, the monthly rent is 12,000. Into 12 you'll have 1,44,000. But there is an unrealized rent of 36,000. So this unrealized rent has to be deducted. So the rent received or the step number 2 for house 2 will be 1,08,000. Then step 3, you have to compare between step 1 or step 2, whichever is higher. So for house number 1 is 48,000. For house number 2 is 1,30,000. Then step number 4, you have to check the loss due to vacancy. So under this problem, only house number 2 has vacancy. That is for 3 months. And the rent per month is 4,000. So we'll come to it's house number 1 which has a vacancy of 3 months, not house number 2. So the rent per month is 4,000. So 3 into 4,000 will be 12,000. So the gross annual value will be step 3 minus step 4. So it will be 48,000 minus 12,000, we have 36,000. And for house number 2 will be 1,30,000. Then after that, from the gross annual value to get the net annual value, you have to less the municipal tax. So according to the problem, the municipal tax is 10% of municipal rental value. So first of all, 10% of rupees 40,000, that is for house number 1. The municipal rental value is 40,000, so we'll get 4,000. Then also we have the sewage cess, that is 2% of the municipal tax. So 2% of 4,000 will be 80 rupees. So in total, the municipal tax plus the sewage cess will be 4,080 rupees. And also for the same house, you have to do this, for the second house, you have to do the same thing. That is 10% of the municipal value, that is 1,30,000, get 13,000. Then plus 2% of the sewage cess on the municipal tax, that will be 2% of 13,000. So in total, you get 13,260. So after deducting the municipal tax, you'll get a net annual value. Then from the net annual value, you have to less the deduction under section 24. So the first one is standard deduction under section 24A, which is 30% of the net annual value. So if you calculate 30% of the net annual value for house number 1, that is 31,920, you'll get 9,576, and 30% of 1,16,740 will get 35,022 rupees. Then you also have the deduction under section 24B. So here I've forgotten to write in to type it. So interest on loan taken will be under section 24B. So the interest on loan for house number 1, it is given from in the problem itself, that is 12,000, and for house number 2 you have to look at the note which has been calculated, that is 64,800. So after deducting the from the net annual value, the deduction under section 24 A and B, so we'll have the income from house property, that is for house number 1, that is 10,344, and for house number 2, 16,918.